Right, let's take a look at the technicals. Ron Williams is with us, technical strategist at MIG Bank. Ron, good morning to you. We've got some euro-dollar charts, so let's have a quick look through these. Euro-dollar reversal pattern oversold is the headline on this.
Yes, well, it's quite the theme now with the political events taking in place in Europe. We've had a major sell-off, as everyone is aware of, about 14 consecutive down days on the euro and record short positions. So a lot of this move is pretty much oversold and unsustainable in the short term. We're likely to get a sharp bounce from these levels, which are just shy of the 2012 low at 126.26. Question is whether it'll be more short covering or a much sharper bounce up to higher levels.
One of our earlier guests talked about the potential for euro-dollar to go to 120, but the big caveat, of course, is what the Fed does at this point from a fundamental point of view, because if they come in with QE3, that kind of makes that trade quite difficult. But do the charts give us any insights?
Well, definitely. I mean, there's a big space between the 2012 low and 120, which is a key technical level. And so that maybe suggests that there will be a fast move between those areas. 120 also is near a key level which would imply that euro-dollar would have lost half of what it made since the 2000 bull run. So that's roughly at 121.30. That's the 50% retracement, as we say in technical analysis. But clearly a psychological area for the market to hold at.
So it's a bold call for a euro rally. I can see where you're coming from, and given record net shorts, I suppose that makes a lot of sense. How high might it go? You think 130? Is that what your chart's suggesting? I
think 130 would be plausible. It was a key breakout level, psychological area, but also a key breakout level from this 4-month range. But at the moment, it's very much a watch and see mode, because the recent bounce that we had just failed, and we saw new lows again. So it's definitely one to wait for confirmation first before we get that upside bounce.
One of our earlier guests was on gold, talking about 1800 potentially. That's his year-end target, at least. Do you see that in the charts at all?
I think for fourth quarter there could be a buying opportunity setting up for gold, maybe one of the best buying opportunities to date. However, in the short term, short to medium term, over the next few weeks and certainly the next few months, we're likely to see further neutral to negative movement on gold, especially if we get a confirmation beneath 1522. That's very much the line in the sand, or what I call the make or break level. If we get a confirmation beneath 1522, then we could see fast moves into 1470 and 1300, and these would serve as potential buying opportunities.
So I noticed from your chart you're suggesting the 5-year trend is under pressure, and arguably it perhaps has broken it. Where would we be on the 10-year trend, though? Because gold's been in a 10-year bull market. Is that underpinned? Is that a lower support level?
It's a lower support level. You need to switch the axes to a percentage scale to get a better target. That 1300 level is actually reflective of that, yes. But I mean, the one thing I would say on gold is it's also part of this broad deleveraging story, where it's been acting more as a risk market than a safe haven. I think it shifts back into safe haven mode as maybe certain volatility increases over the next few months.
And presumably, QE3 is more important to this gold trade than the euro-dollar story?
Possibly. Yeah. I think that's what the market might be telling us at the moment, the way gold has been behaving today.
Can you forecast volatility from here? It seems very much to have been binary to policy announcements.
Yes, well, I mean, if we look at the VIX as a proxy, suffice to say, we are rising from historic lows last seen pre-financial crisis 2007. So that suggests that there still is a lot more room to the upside for potential mean reversion. Whether it's there are a number of reasons and factors as to how this could pop higher, but I think that the key thing here is to wait for further potential spikes during this seasonal weak period, set in May and go away, which suggests further bearish social mood and also negative surprises over the second and third quarter.
Sorry, we don't have time for the question, Chris, but we'll come back and pick it up with you. Ron, thanks so much for running us through the charts this morning. Ron Williams, technical strategist at MIG Bank.